Welcome to Bloomberg Markets. I'm Matt Miller. Tech is leading gains this afternoon as investors await CPI inflation data due out tomorrow and bank earnings later this week. Let's get a quick check on these markets. First off, in terms of the indexes, the S&P adding 0.8% at 5740, not making back everything that we lost yesterday. Remember, we closed Friday evening at 5751, so we still have a ways to go before we gain that back. But it is, of course, the NASDAQ 100 putting up the biggest gains, with the Mag 7 rallying up 1.25%. The 10-year yield unchanged, but over 4%. So still making those valuations look a little bit less frothy. And then Brent crude right now down 5%. It had eclipsed $80 a barrel. Now it's trading back down to $76.95. In terms of the midday movers that we're watching on the equity side, Bloomberg's Abigail Doolittle joins us and has a look under the hood.
Under the hood here, and here we have Robinhood up 7.1% at its highest level since 2021. This after the company has announced their first investor day. So we do have shareholders, analysts, and investors excited about this possibility, and it will be on December 4th. So again, up 7.1%. Turning to tech, we have lots of different tech names higher. It seems to be an overall sentiment, but there are idiosyncratic reasons as well. DocuSign up 8.2%, being added to the S&P 400 mid-cap index. We have Palo Alto Networks up 5.3%. The street has put out some positive notes recently. NVIDIA up for a fifth day, and then take a look at Apple after falling more than 2% yesterday. Today, bouncing back 1.4%. And of course, we are tracking Hurricane Milton. If we go into the Bloomberg and use the HURR function, go function, here is, I believe, the eye of the storm, and it's going to be moving right here. I was just speaking to Ken Johnson down at the Ole Miss, and he was talking about the idea that it will be moving right through the I-4 area. It could really, unfortunately and sadly, tragically, create quite a bit of devastation in that area. He's estimating that the insurance cost could be close to Hurricane Ian, $65 billion. That said, it was downgraded to a Category 4 from 5. So today, after yesterday's losses for many of these insurance and reinsurance companies, Matt, well, today we have gains. So these stocks are bouncing back.
All right, Abigail, thanks very much. Abigail Doolittle talking to us about the individual stocks moving the market today. Let's get now to some of our exclusive conversation with JP Morgan CEO Jamie Dimon. He shared his thoughts on the recent market momentum and told us whether the Fed got it right with its recent jumbo rate cut. He spoke with Bloomberg surveillance co-host Lisa Abramowitz.
Soft landings are hard. I hope it happens. I don't know. I just wouldn't count my eggs in that one.
Do you think
and markets are open. When you say open, they're very, values are high. They're not low. Both equities and bonds, credit spreads are very low. So they're open, but people are saying they're not open for IPOs. So some IPOs, when we just did one of the largest ones of the year, like last week, they're open for those who the market wants to buy today. But don't assume that they're not open. And, sometimes people go public, they don't like the price. That's a very different thing. And you should think twice about that when you think what a company's worth much more than the market might know.
Yeah, that maybe it's an assessment of what you're looking for rather than the actual market being closed.
Exactly.
You said that there are a lot of inflationary things that are coming down the pike. Do you think that it was a mistake for the Fed to cut by 50 basis points?
No, actually. I mean, you got to separate the here and now. Inflation has definitely been coming down. They don't want to go into recession. Unemployment has been going up. They raised rates. They were late raising rates, but they raised it very high, rapidly to 5%, which I think is the right thing. And they're right to take their foot off the gas in that one. I don't think it matters that much, 50, 25, honestly, but I think that was okay. If inflation comes back, I'm looking at future things. The remilitarization of the world's inflationary, the fiscal deficits of the world, particularly the United States, are inflationary, the green economy is inflationary, demographics are inflationary. It's very possible energy prices down the road, I'm talking about 2 or 3 years, will be inflationary. Those will hit later. Now, they should react at that time to those things, but I don't think you can anticipate that. We don't know that that's going to happen.
Thanks, Lisa Abramowitz, for bringing us that exclusive interview with JP Morgan CEO Jamie Dimon. For more on his comments, we're joined by Bloomberg Intelligence senior bank analyst Alison Williams. And Alison, we got really a lot, I thought, out of that interview. His comment on the Fed, I think, said something about his political leanings more than about the Fed, right? And he, the entire time, was saying the U.S. has too much regulation, implying it was more than in Europe. The deficits are something that we really need to be paying attention to, and that we need more public figures on the cabinet. He said he thinks half of the cabinet should be, basically CEOs. Is he gunning for a spot on that table?
So I don't think he's gunning for a spot. I think he is just speaking to what he thinks is right for the country. He's never been shy about that, and that's why he's always very interesting to listen to. I thought, a couple of the takeaways for me were, one, that he just continues to think structurally, right? So the Fed did the right thing, but he's pointing out that that's a near term and pointing to some of the structural risks out there. The biggest one that he's concerned about is geopolitical risk, which obviously can translate into economic risk. But really, geopolitical risk as something being the bigger thing, the bigger risk that he thinks about. Also, he talks about the fact that we have too much regulation in the U.S. and how that can stymie growth. In particular, he talked about the impact to IPOs. And so I think those are consistent but important to think about. And finally, risk management. I think this is one of the things that has made J.P. Morgan great and has shown his leadership in terms of managing a bank, because I think a lot of times when he does these interviews, there are headlines around comments that he makes with regards to interest rates. Today he was talking about deficits and the impact on inflation, but he's talking about, thinking about risk, thinking long term, and managing to a variety of risks, downside risks as well as upside risks.
They kicked off, somehow they got into artificial intelligence straight away, I guess because they're at a tech conference there in London. And I thought it was interesting. He said he has 1,000 artificial intelligence employees. I don't even know exactly what that means, if they're individual robots or programs. Certainly they're not 1,000 large language models, because that would, cost $1 trillion. But what do you think he's using artificial intelligence for? Could it be that risk management, or is it more kind of day-to-day operations?
I mean, for sure, it's probably both.
Yeah.
It would be interesting to know how he defines those employees, right? Because there's a lot of definitions in the way you can look at things. Are these employees working on dedicated projects? Are these employees, helping to train the language models? Hedging is one thing that Jamie has talked about that J.P. Morgan is using AI effectively for. They've talked about that even back at Investor Day. And I think, similar to how banks have embraced a lot of different technologies over the years, it starts in the back office. It starts in risk management, but then increasingly thinking about how they can move that towards the front office and how they can think about not just making things more efficient, but generating revenues.
You've just explained something to me that I've gotten wrong all morning long, which makes me feel really silly. But he's talking about employees working on AI. I was thinking about AI employees. So thank God we had this conversation before I embarrassed myself on live television. Alison Williams, thanks so much for joining us from Bloomberg Intelligence. Coming up in about an hour from now, General Motors is going to begin its Investor Day with plans to unveil a whole new EV battery strategy. We'll talk about that next, something I feel much more comfortable discussing. This is Bloomberg. This is Bloomberg Markets. I'm Matt Miller. Time now for Stock of the Hour. General Motors is set to unveil details of a new EV battery strategy, and they are hoping a former Tesla exec can help the company charge in a new direction. For more on this, let's bring in Bloomberg reporter David Welch. He is live from Detroit. David, how important is this? I mean, is this really, life or death in terms of the future of a car maker if we're going to be going all EV anyway?
They're going to have to make changes here, and every company is, as they look at their battery strategy going forward. Batteries are expensive. It's the most expensive part of an EV, and it's what makes them lose money right now, and what also puts them out of reach for a lot of consumers. Now, GM's getting their costs down like everybody is, but as they looked at this thing, this idea of one battery fits all, this modular battery using pouch cells, It worked to get a lot of vehicles out quickly, but now they're realizing there are other ways to get cost out. And that's by fitting more cells in one pack without these modules, perhaps, or using prismatic cells because you can fit more of those inside a pack. Everything to get more cell inside of a pack and less other stuff so that the batteries are lighter, batteries are cheaper. And then over time, you get the cost of your electric vehicle down. The company can make money on them, and consumers may be able to afford them more readily.
What has GM been doing differently than its competitors? If I look at a stock price of General Motors versus Ford, Stellantis, Volkswagen, BMW, and Mercedes-Benz, we pulled it up here. General Motors has outperformed all of them. Now, I guess you could say I'm just cherry picking my time period, right? But everybody else seems to have taken huge earnings hits or been warning on profit from certainly Ford and Mercedes-Benz. How come GM has avoided that?
Look, while GM's EV business first half of the year kind of stumbled and they were working to get through these production issues, investors lost interest in all that. So in a way, it was a lucky time to be struggling with that because their internal combustion business, the core GM business, has done very well. They've kept pricing up even when some others have been adding incentives and rebates. They've had to do a little bit of that, but less than the market. Look, really, the company's been a profit machine. That's how they've been able to buy back $21 billion worth of shares over the past about 3 years. That's a lot of money. So look, the core business is throwing off tons of cash. They're not having the sales issues like Stellantis has, where Jeep is struggling. Ram is the oldest pickup on the market, not doing great right now. Those are their core products. Ford's had quality issues that have actually hurt the bottom line because they've had warranty costs. GM doesn't have those. The core business is just humming for them, and that's what's got the stock price up better than most of their peers. That's not to say investors love auto stocks these days, but in a sector that's not at the moment beloved, GM's done fairly well.
All right, David, great having you on the program. Thanks so much. It's a bit unfair to refer to David simply as a reporter. He is also the Detroit bureau chief and the author of Charging Ahead, GM, Mary Barra, and the Reinvention of an American Icon. It's a great book. I recommend picking it up. Let's get more on the broader EV charging space. We're joined by Badar Khan, CEO of EVgo. It's one of the major companies behind the U.S. charging network and working very closely with General Motors. Obviously, Badar, what can you tell us about improvements, that we all know need to be made in terms of the charging network? How close are we to getting one that's really much more user-friendly?
Well, Matt, thank you for having me. Look, in terms of the charging network, I think there's a couple of things that we need to think about. One is we need to have a much larger network, so we need to increase the scale of deployment. The conditional commitment for a $1.05 billion loan that we announced last week helps us achieve that goal. And then secondly, of course, as you just said, ensuring that the quality of the network is getting better and better. It's a major priority for us. We announced a new flagship deal with GM, a partnership with GM. We've been in a partnership with them for several years now, but we've announced a new program to build flagship stalls. So these are stalls with much larger sites, many more stalls per site, with canopies, with pull-through access, with security and lighting, and so taking the customer experience just to a whole new place.
A lot of people have wondered why we don't see more of a saturation. I've spoken to, for example, the CEO of BP and asked him, why don't you put a charger in every gas station? It doesn't exactly work like that, is what he told me about. But now that we've got this big spending Uncle Sam behind us, can we really start to grow the EV footprint? And how quickly do you expect it to go?
Matt, I think we absolutely can. Americans are buying more battery electric vehicles every year. So today we've got about 4 million battery electric vehicles. Most people expect that to get to about 30 million by 2030. And to support that, we need to really build out the infrastructure, the charging infrastructure. We focus on fast charging in urban locations that's convenient to people that perhaps don't have charging at home. And so they're going about their lives, running their errands, and they need to rely upon our public charging to support their needs. There's around 45 to 50,000 public fast charging plugs or stalls in the United States, and we think that we need to get that to around 250,000, plus or minus, to support that 30 million battery electric vehicles by 2030.
How quickly do you think charging is going to become as simple and commonplace as filling up a car with gas? I mean, I test new cars every week, and I have a lot of fun driving EVs. They're very quick and a lot of times very luxurious, very economical, obviously. The one pain point is, unless you charge it at your house overnight, filling it up with juice. When do we get to a time where it's just as fast as filling up my Dodge Challenger?
Well, look, so a couple of things here. We are deploying 350 kilowatt chargers, which are capable of charging. I don't know what kind of car you have, Matt, but they're capable of charging a battery electric vehicle in 20 minutes or less, depending upon the battery in the vehicle. So that's important, and it's quite a bit faster than Tesla's supercharger network at 250 kilowatt speed. I think an important pain point for customers is the payment process. So we have something we call Auto Charge Plus, where when you stick the connector into the car, the connector detects the vehicle, detects you and your payment method, and you don't need to fuss with getting a credit card out or RFID card or getting your app out. So that's an experience that customers really rave about. We are very excited to be working on a next generation charger that just takes the experience to the next level, where we bring all of our experience. We have over 1 million customers. We're one of the largest networks in the United States, with a global power electronics company to jointly design a completely new experience. So a new site configuration, a new dispenser, bringing together a human-machine interface, design, criteria and methodology, just to develop a completely new experience. So we're quite excited by that.
I'm sure that, for a long time, Tesla Supercharger, access to that network was a selling point for the vehicle. Do you expect your technology to be a selling point for a General Motors vehicle? I mean, certainly if I don't have to fuss with a credit card or signing into an app or, playing with a touchpad on a charger that inevitably isn't working anyway, I would prefer to drive a car like that.
I think so. I think that's absolutely right. The customer experience is absolutely paramount, and getting to a next generation charging equipment. When we think about the experience, we think about it in terms of 4 respects. Number one, when you get to a charging station, that you don't have to wait. So building sites that have more stalls. Number 2 is building a charging experience that has faster charging. So that's why we're focused on the 350 kilowatt chargers. Thirdly is that payment process that we talked about. And then 4th is that the charging experience works on the first go. That is, this isn't a gas station where you're connecting a physical pump. There's hardware and software between the connector and the car that needs to connect together. That's why we have a lab in California where we test the interoperability from a hardware and software perspective of every single battery electric vehicle with our charging network.
Fascinating stuff. Very cool. Badar, thanks so much for joining us. Badar Khan there, the CEO of EVgo, talking about the technology he's creating in its partnership with General Motors. Coming up, Roblox facing new reports that have short seller Hindenburg betting against the company. Those details are next. This is Bloomberg. This is Bloomberg Markets. I'm Matt Miller. Shares of Roblox are tumbling today after short seller Hindenburg Research said it is betting against the gaming platform. It said in its report that Roblox inflated key metrics, and it said more. For that, we're going to bring in Bloomberg's Bailey Lipschultz joining us now. Bailey, I am talking about, of course, the comment from Hindenburg that Roblox is I think they said it's a pedophile hellscape, which sounds very bad. To what are they referring?
Well, that's not good. But let's step back to this summer when Bloomberg Big Take had a story called Roblox's pedophile problem. So this is something that has been long discussed, the ability for potential pedophiles or so-called creepers to have access to Roblox platform, which is a video game platform, be able to potentially target young children and kind of exchange videos, film, different things kind of on the platform. And again, this is something that's been long discussed not only by Hindenburg, by Bloomberg Reporting, but also by Bear Cave, which has run a number of reports going back to 2022. Matt, the big thing that was new that stood out from the Hindenburg accusations, again, Roblox denying all of this, is that they say, according to Hindenburg, who's betting against the company, that Roblox effectively has two sets of books for counting users, one for internal business decisions and one for the finance team that reports metrics to investors. So they're basically alleging that Roblox is double counting either bots or individual accounts that are kind of being double or triple counted at times.
I mean, they're essentially alleging fraud. What has Roblox said in response?
They've outright refuted it. They've said that they totally reject the short report claims, kind of laying out that they actually, if you look at certain metrics, are actually doing quite well. Hindenburg came out with another tweet saying that they failed to report it, failed to address their main concern. So we're seeing what's really played out with some companies, barbs being traded back and forth between a company and a short seller. And Hindenburg, again, this is the guy who took down Nikola, has had successful at times short bets against Adani, against Block, as well as most recently Supermicro Computers. So kind of one of the most well-known, if not most sought-after short names right now.